top option story, the bear claws are out for Apple. Apple puts reach a 10-month high after the iPhone map flaws come to light, and CEO Tim Cook publicly apologizes for the app's inaccuracy. But that hasn't stopped investors from hedging this name. So let's see how the experts are playing this. Joining us now is Tim Travis. He's the CEO and founder of TNT Capital. Tim, thank you so much for joining us. So let's talk about Apple for a moment. I mean, it's such an interesting story here because everybody sort of flocks to the iPhone 5, but there are still a lot of concerns about the Maps app and about the company's executions right now. So let's first of all talk about sort of the fundamental case with Apple, and then we'll move on to exactly how you're playing it.
Sure. Well, thanks for having me. I mean, I think if you look at Apple on a price-to-earnings ratio, it's very reasonable. But I think the primary concern that someone like myself would have is that how sustainable are those profit margins? You know, they make over 50% of their revenue from the iPhone with over 50% gross margins. And now competition's really catching up, you know, a lot more quickly than they had in the past. And so any regression to the mean could jeopardize that. So that's why I don't think you want to just be a huge bull on it. I think the law of large numbers itself will ensure that, you know, the company's returns aren't likely to be as high as they've been in the past. Can't expect that.
So how are you using the options market here to sort of hedge against the stock, you know, not continuing to run like it has been running?
Sure. Well, what I would look at is if I wasn't in Apple, what would I do to establish a position? And so, you know, one strategy that you could use is you could sell the January 2014 $640 puts. Those puts this morning were going for about $92 per share, or $9,200 is the premium that you'd collect. So basically, there's two things that can happen, assuming you hold those options to expiration. One is if the stock closes below 640, you're going to end up owning 100 shares of Apple at a break-even price of 548. So that's about 19% below the current price, really protecting you on the downside. And if Apple closes above 640, then your return's going to be, you know, roughly 17, 18%, you know, in just over a year, which I think, you know, when you look at this low interest rate environment, that's a pretty solid return, and most people would be comfortable owning the stock at that level anyway. So that's how I would suggest playing it.
Hey, Adam, get in here.
Okay, you know I can't help myself when we're talking options, being a former options guy. Hey, Tim, sure. I'm kind of fascinated. At first, I sort of liked the look of your trade, and then I looked at a longer-term chart, and the support line for Apple is so much lower than where we are, plus we're just coming off long-term highs. That's what I'm talking about. I'm not sure I want to be short puts. In fact, I might take the other side and actually buy some puts. The near-term puts are trading at about a 27, 28 vol. That's pretty cheap. If I wanted to take the other side of your trade and actually buy some near-term puts, do you have one that jumps out for me?
You know, not particularly. I'm not a chartist. I don't disagree with you. I could easily see the stock trading down over the short term, but we're more long-term value-oriented. So I would gladly sell you those puts. You know, any puts that you wanted to buy, I would sell, especially with implied volatility being what it is. So that's how we suggest playing it, is just a more conservative long-term approach. You know, if you want to time when you're going to sell them to maximize the highest implied volatility possible, I don't think that's that realistic. So that's why I suggest that strategy personally.
Hey, Tim, I'm curious too. I don't get quite as deep into it as Adam, admittedly. But 548, then, is that a price that would be sort of a floor in the stock? You don't think it would go lower than that? Is that what you're sort of betting on as well?
Yeah, sure. If it did, it would give you the opportunity to accumulate the stock at an even better price. So what's attractive about 548 is, you know, you've got about $100 per share in cash and investments. So that gives you some support. And then Apple's supposed to earn about, you know, let's call it $53 per share next year, generate about $50 billion in free cash flow. So that would be about 8.3 times forward earnings. And I don't think that the bottom's going to fall out on the company or the stock. So I'm very comfortable owning it at that price. I just think it's a more disciplined approach, and that's why we like that strategy.
Okay, thanks a lot so much to Tim Travis of TNT talking to us about options. And the bottom line on this option, Tim Travis recommends selling the Apple January 2014 640 put. He reasons that if Apple closes above 640, you end up keeping your money. If it closes below 640, the stock would have to drop almost 20% before you even lose a penny. And that does it for options. Stephanie